Hello, everyone, and welcome to our webinar on current trends in public entity pooling. My name is Ann Gergen. I am AGRIP's Executive Director. What I'm going to share today is very brief information about the scope of public entity pooling. This is the source of all of the other information and intelligence that I'll share today. I'll talk about the trends in 4 primary lines of coverage that we know are typically provided by our member risk pools. And then finally, I'm going to talk about some of the current influences into pooling operations, things that are influencing every pool within our midst. Now, if you are watching this webinar, you probably already know what a public entity pool is. You probably know what typical coverages are that are offered by a pool. But we know that we have many new people within our pooling community. So as a grounding, it is important to know that pools are here as a support for the local public entities that they serve. And pools are, by definition, really a partnership of, really an extension of those local public entity members. Now, the goals of pooling, even amid pools with different coverages, pools with different membership, pools in different jurisdictions, the goals of pools is the same. Number 1, to protect the people and the assets within your membership. That is our purpose. Number 2, to clear the path so that local public entities can do the work that they need in the best interest of their constituents, of their students, of their families, and of other local interests. And then number 3, to support the local public entity services, processes, and decisions to allow our local public entities to make the decisions that they need to make in their own jurisdictions. Now, the trends that I'm going to share today come from pools throughout North America and in Australia. Collectively, our member pools in the US represent about 80% of all local taxing jurisdictions. That is approximately 75,000 of the 93,000 or so independent taxing authorities in the United States alone. Pools in our Canadian provinces and territories that participate in AGRIP represent about 60% of the municipalities overall in those Canadian provinces and territories. And in some cases, those pools, reciprocals, represent essentially 100% of the municipalities or the schools in their jurisdictions. Now, in AGRIP, we are in pretty constant contact with all of our member pools. We log over 300 pool conversations every single month. That's about 16 conversations every workday. So we are really readily aware of what it is that pools are doing, what their issues are, and what they're working on. If you call us, no matter what your question, no matter what the kind of issue is that you're facing in your pool, we probably know of another pool or 2 or 6 who are dealing with exactly the same issue, experiencing exactly the same thing. Now, I'm going to rely on those 300 plus conversations each month to share with you this first set of trends related to property coverage. The very first thing I'm going to talk about is weather. What should catch your eye in this first set of bullets are 2 powerful words: increase and unknown. We know that we have an increase in both frequency and severity of weather events, but we have unknown shifts in those patterns. How much more frequent, how much more severe are those shifting weather patterns likely to be, and for how long? We also have increasing property values, and that really means 2 things. First of all, it means real increases in the underlying value of properties. This isn't just about the property real estate market, but also about supply chain disruptions. It's about limited supply. It's about the availability of labor. All of those things having an influence on what those property values are doing. The second thing behind increase in values is the demand for increases in property valuations, which is really a byproduct of those underlying considerations, meaning that your pool is increasing its valuation of the properties that it covers more regularly and with a greater degree of specificity, probably not just raising that TIV or total insured value by 3% or something every year or every couple of years, but making more discerning decisions about increasing property valuations and inspecting those valuations on a more regular basis. Now, the other influence in property right now, unsurprisingly, is cyber coverage and cyber risks. The story of cyber risks is kind of almost exactly the same as the story for those other kinds of property risks. The two words, increasing and unknown. Now, a year ago, the risk of claims, cyber claims, was in terms of the number and the cost. We had some unknowns in the number of cyber claims to expect and the cost of those claims to expect. Neither frequency nor severity has been quite as bad as expected within local public entities covered by pools, although perhaps the numbers, the frequency, are more notable than the cost. So we have seen some frequency of claims, but the cost of those claims hasn't been quite as much as we expected. The unknown is whether the exponential growth in the number of cyber claims, and there is exponential growth. 3 claims 1 year, 6 claims the next, 12 the years thereafter. We don't know about the exponential growth in the number of claims or the costs of those incidents and what the likelihood is of them becoming more significant. In particular, we know that we have to watch right now for those fraudulent instruction claims. Those are very prevalent within local public entities served by pools. Now, when it comes to cyber, there is a very different risk dynamic because we know that it's hard for just about any local public entity to keep pace with a changing risk profile, regardless of the public entity's size, but most especially for smaller entities. It's just hard to keep pace with how quickly cyber risks change. It is also difficult because those cyber risks are changing so rapidly. It's difficult to invest as much as any public entity probably needs to in hardware, software, and skills to protect themselves against those cyber risks. So there's this disconnect. There's this disconnect between how quickly those cyber risks are changing, are escalating, could present very real risk, and between how readily able our member entities are in order to address those cyber risks. Now, the real story when it comes to property, weather events, and cyber risks on the whole, the real story is one of the reinsurance and excess market. We know that we have, as pools, an increasing cost of coverage. It costs more now to buy the reinsurance or the excess coverage that we need to buy for property risks. In 2023, between the 1/1 renewals, the 7/1 renewals, pools were seeing typical property excess, property reinsurance increases in the range of 20 to 60%, in some cases even more than that. And not only were pools paying those increasing reinsurance and excess premiums, but they were also faced with decreased availability in the reinsurance market. Now, that was decreased availability specifically for cyber, meaning that for many pools looking to provide pass-through coverage, for instance, they were unable to find coverage at all, or if they did, they found very selective underwriting as part of that coverage. And in property overall, frankly, there was just a limited number of players, there were limited quotes, there was limited capacity, there were limited limits, meaning specific limits, aggregate limits, sublimits, you name it. Property coverage was expensive and it was hard to come by in 2023. We saw across many pools increased retentions at the pool level, meaning the pool itself was holding more of the risk. At the same time, it was also paying increases in premiums for that property excess or property reinsurance. We also saw, back to those property valuation considerations, forced increases in valuations for property that the pool had in its membership. In some cases, not very many, but in some cases, we actually saw reinsurers or excess insurers put underwriting restrictions on the pool and require the pool to come to the reinsurer for pre-approval before adding new members for property coverage. That property market looking forward, it's going to remain very tight, very difficult, in particular for states that are in a catastrophic loss area. So if you're in Texas, if you're in Florida, if you're on the coastal areas in the US or Canada or Australia for that matter, a difficult property market in 2024. Overall, it seems reasonable in this environment to expect that rates are going to be better, renewals are going to be better than they were in 2023, assuming that you're not in a place in your pool did not experience large losses. Although saying that the property reinsurance renewal is expected to be better may not be saying a whole lot. Frankly, looking at maybe 15% increases, assuming you have good experience, that's going to be a pretty successful renewal coming forward in 2024 based on what we know today. Now, in some cases, because of all of this market upheaval, because of the property pressures, the property valuation pressures, because of the cyber risks, really for the first time in any number of years, we are seeing pools passing along some of those restrictions, some of the limitations on coverage, some of the underwriting restrictions, some of the new sublimits. Pools are passing those things on to their members in some new ways. And we see pools that are making strong investments into mitigation efforts, risk management efforts, things like building sensors for water intrusion, things like roof replacement programs for school roofs where they might be at risk for hail damage, things like network intrusion detection for member entities to help those member entities better prepare for and mitigate cyber risks. All of these things are great because these are the kinds of investment that underwriters are going to be looking for, reinsurance underwriters are going to be looking for from pools, that they're making an investment in some sort of risk mitigation along these lines. In this environment, it's not surprising. We are hearing comments from pools along the lines of, this being an unsustainable market. We can't continue to take these kinds of increases that we're taking. We can't continue to pass these kinds of restrictions along to members and expect to retain our membership. But really, as much as we all know and understand the difficulty of the circumstance, this is a market that has to be sustainable. There's not going to be a great big new player entering the market in all likelihood. The rate increases are going to get better, but they're not going to go away altogether. Every year, of course, is dependent on the weather events that happen that year. Every year is dependent on the cyber events that happen this year. This is actually the very purpose of pooling, right? Is to appreciate and understand that we have good years in order to offset bad years, that we're going to price to the risks we face, even when that means that we have to have a difficult conversation with our members. But this is a new environment for many of our pool governing bodies, for many pool staff who have been around for a long enough time, 10, 15 years, but who maybe haven't experienced a hard market quite the way we're seeing it today in this property market. It takes a little bit of a different discipline and experience for pools and for their governing body members who haven't gone through this before in their recent history. So this is a place for us to really be asserting strategic vision and strategic conversations, making sure that we are underwriting appropriately at the member level, that we are communicating well and with the totality of the environment to our members, even when it's a difficult message that we have to share, making sure that we're making the best use of our net position and understanding that that's what it's there for, but also that we can't deplete that net position resource all in a given year, for instance. Making sure that we understand what it means if, because of this market environment, we might need to watch some members leave and what that looks like when those members want to come back to the pool. So this is that hard market environment that created pools in the first place. There's some different conversations that have to go on as part of this market environment. It's what pools are meant to do. This too is a really important time for all pools to be having a really strategic conversation about what their reinsurance relationships look like, what that relationship dynamic is. And on the one hand, this is a time in this market where a pool might be going out to look at alternatives for reinsurance. You might need to be adding more reinsurance players into your basket for your pool. You might want to be thinking about what additional reinsurers or excess insurers you can partner with. On the other hand, the relationship that you have with your existing reinsurers and excess partners is incredibly important. And the last thing any pool wants is to have a claim that is not going to be paid. So making sure you have that perspective on what the payment looks like, what the relationship looks like, and what the totality is of the exchange between you and your reinsurance and excess property providers is really, really key in this market. I want to talk next about the liability environment and the losses that pools are facing. Now, the first thing I want to talk about is just the liability landscape or environment on the whole. What are the underlying trends in public sector liability that are having an influence on the outcomes and the loss experience of pools? First, the specialized focus by law firms that are bringing liability claims against public entities. So we know that there are very specialized law firms for sexual abuse and molestation claims, for instance, social justice claims, even sewer backup claims, right? That we can hone in and see that there are maybe just a handful of law firms who are specializing in bringing cases against public entities for these kinds of claims. Second, legislative changes. We hear this every day from a pool, give it any given state or province or territory, increasing tort caps, removal of the statute of limitations for certain sorts of claims, police reform, other legislative changes that are in some way eroding the protections that local public entities have historically benefited from. And then third, social inflation. And this is really talking about that changing norm of how the public at large feels about holding people and entities accountable or responsible for certain activities or certain claims. It's again, partly that eroding support for local public entities and the desire to punish someone, some wrongdoer. It's also the impact of third-party funding on litigation, as well as an impact of all of those legislative rollbacks on protections for public entity operations. So we have to be a little careful because this is the environment in which things are happening today. And if you're in a pool where you have had the benefit of this not influencing you yet, I think the difficulty or the magic maybe is in knowing that it's coming. This is not a case of just dismissing these sorts of things as saying, oh, well, that only happens, on the West Coast. It's not going to get here to me in Middle America. Or the danger in saying, we have really strong protections in place and we've defended all these claims successfully. All of those things may be true, but they are only true until they are not. And so these kinds of influences are really things that we can expect will have an impact in one way, shape, or form to just about every pool at some point. There is evidence of shifting norms everywhere. Now, on the other side of this slide, you have all of those shifting norms, all of those environmental trends, and then you have the actual losses. When it comes to liability, different pools have different experience in some of their baseline underlying liability losses. You may have a certain baseline of employment claims that you're used to seeing. You may have a certain baseline of sewer backup claims that you're used to seeing, or of negligent road maintenance or something like that. And that's not to diminish the impact of those claims. Those are very real claims within your environment. And you might be tracking when they go up, when they go down, what sorts of things influence those claims. That's worth paying attention to for sure. On the whole, there are also some claims that have, a magnitude of impact that even if you're not writing coverage or if you have a membership that doesn't quite fit the profile, you still want to have awareness about these kinds of claims because they're influencing your operating environment overall, meaning your excess and reinsurance placement again, meaning if you're in a regulated environment, perhaps that, meaning your legislative environment. And the two areas of greatest focus right now are law enforcement and corrections, and then sexual abuse and molestation, or SAM. In some cases, pools are looking at ways of carving these coverages out and creating standalone coverage. For instance, standalone coverage for SAM. We know some pools are looking at ways of doing that to isolate those risks a little bit more effectively and be able to talk with members about those risks that they face. We know too that some of those things on the left-hand side of this screen, like legislation, are having a direct impact on law enforcement and corrections. Maybe that has to do with the officer training levels that are required in your jurisdiction. Maybe that has to do with challenges to qualified immunity, or maybe it has to do with other state-specific police reform efforts. What does all of this mean for reinsurance? That's always a big consideration for pools. Well, first of all, if you don't have law enforcement, corrections, schools, or youth programs, you're going to be likely to have a better reinsurance renewal in 2024. However, for everyone, for every pool, that underwriting process, reinsurance and underwriting process, is probably going to be a little bit daunting. There's going to be lots of questions in these risk areas, and you're going to have to sort of demonstrate, if you don't face these risks, how you don't face these risks. We know that from a reinsurance and excess perspective, that loss development in some prior years, which has been happening, can influence pricing. And so be watching those prior year adverse development trends in your own book of business so that you can be anticipating what you might see from a reinsurance perspective. Now, on the liability side, capacity and availability within reinsurance and excess markets is a little bit more stable than it is in property. But those same relationship considerations exist, right? Do you need to add to your basket of players? And how do you balance that with the importance of a really great relationship between your pool and its reinsurer or excess carriers? Especially this is true in liability claims, which can be more challenging in terms of aligning coverage terms and the processing of claims. When it comes to how pools are managing through all of these liability considerations and the things that pools are offering outward to their members, what do we see in terms of response to these liability trends and uncertainties? Just like we've seen an increasing specialization of the firms that are bringing cases against public entities, we also see that pools are focusing their efforts and specializing their efforts more concertedly. That means claims work and defense work. So making sure that you're really funneling those SAM claims and the SAM defense work to the firms who are most appropriately structured and able to handle those claims. Maybe it's law enforcement claims would be another good example of that. We see even claims handling becoming more specialized. So maybe you have an adjuster on your claims team who is really your specialist in handling those sex abuse and molestation claims and making sure that they're respectful in the way that they're dealing with the plaintiffs in those claims. From a risk management perspective too, our pool resources are becoming more specialized. So maybe you have a law enforcement risk management specialist on your team whose job it is to really interact with those law enforcement and corrections agencies. Maybe you have a cyber risk management specialist looking for ways that we can target some of our risk management resources to really benefit our members. And that's that second bullet about providing direct resources. In some cases, we've seen pools get really more direct and more targeted in the risk management resources that they're providing. Maybe that's the pool doing that intrusion testing for member public entities. Maybe it's the pool giving advice directly to parents and teachers about SAM risks and about how to control for those SAM risks. So lots of ways that pools are looking to deal with some of those liability trends that are experiencing by really cultivating and curating their resources to be as targeted and specific as possible for their member public entities. Now, I'll talk next about workers' compensation coverage and what we're seeing among all of our member pools. Work comp, of course, is a state-specific experience, but even so, as specific as your state statutes are and your state work comp benefits are, the commonality among almost all pools is one about presumptions. We see an expansion of presumptions. And when I'm talking about an expansion of presumptions, I'm really talking about who is covered. And there's a couple of ways that who is covered is expanding in presumptions. First, by role. So is it full-time or paid-on-call firefighters who are covered? Are police covered? Are EMS workers covered? Are teachers covered? What kind of roles are covered under our presumptions in our state? And then also there's expansion in terms of who might qualify for some of these presumptions. So for instance, is it only certain named conditions? Is it cancers of any variety? Is it mental health, which might be something like mental, meaning that you have a mental health coverage, even if there's not a corresponding physical injury of some variety. Maybe too, it's about who experiences or just who sees an incident, and that is affecting who is covered. So it's really who is covered under the presumption, and also what are the conditions that are covered under the presumptions. Now, I talked about that idea of who's covered. Is it just somebody who experiences a certain activity, or is it somebody who witnesses activities? That's really talking about that PTSD sort of claim, right? So am I covered under a PTSD presumption if I am the one who is actually directly involved, or if I see an incident take place, or even in dispatch, if I'm listening to an incident take place or hearing the calls come in, would I be covered under an expanded presumption for PTSD? PTSD is a big unknown when it comes to work comp, whether or not it is a presumption in your particular jurisdiction. There are tons of questions about PTSD and a lot of variation in how PTSD workers' compensation claims are managed, are handled, are covered from one state to the next. So how does PTSD have to be diagnosed, or who can diagnose someone with PTSD? How do we treat PTSD? How do we prevent PTSD? How long can a PTSD claim go on? And what happens if it is a recurring claim? Excuse me, or the person experiences a recurrence down the road. The biggest unknown when it comes to PTSD, because this is so novel, because we're managing through these claims really for the first time and only in the last few years, we don't know what the total ultimate costs look like for PTSD. We don't know how long these claims could last. We don't know what the recurrence could be. We don't know what the most important measures are for mitigation. We just don't yet have a good sense of what the ultimate impact of these PTSD claims might be. That's a big, big question mark in workers' compensation. The good news from a broader market perspective is that work comp excess market, it's pretty stable. The players are there, the coverage is there. There might be some cases where you're seeing at your pool a split retention. So maybe you have public safety officers and coverage have one retention, other workers have a different retention. Maybe there is some degree of increase in your price for excess workers' compensation insurance, but really those rates even are relatively flat, plus or minus 5% maybe. That's not the norm if you go back a ways. So I guess the message here is enjoy that this seems to be a bit of a silver lining when we compare it to property and liability, because it hasn't always been that way. It hasn't always been the case. Okay, let's talk next about our employee benefit pools, or really in this case, what we're talking about here are health pools. When we talk about health coverage, pharmacy is always the main point of conversation within those health benefit programs. We know that specialty drugs are a major driver for health pools. Those specialty drugs are expensive in and of themselves, and they are being applied to new conditions, treatment for things that maybe they weren't originally intended, but have been found to be effective. So the concern here is the cost of the specialty drugs and the growing use of them, growing frequency of use of them for secondary conditions as well. And in addition to sort of the normal specialty drugs, which in and of themselves were expensive and have been increasing in use, there's another sort of subset of those specialty drugs, which are gene therapies. The FDA has approved a number of new gene therapies over the last 18 or 24 months or so, and those tend to be expensive and effective, or rather effective, but also very expensive. And so that presents a challenge for pools who have to decide how to cover those gene therapies, how to rewrite their plan docs in order to cover or not cover them, how to be mindful about balancing the need for those treatments against protecting the totality of the pool's assets for all of the more typical claims that the health pool might be experiencing. Speaking of typical claims, right now in this environment, mental health is becoming a pretty typical claim for a health pool. Certainly, we've had increasing awareness around the importance of mental health. We have increasing treatment available for mental health, which is a great thing overall, but it does have the influence of increasing those overall costs within a pool. In fact, we've got one member pool who is on track to see their mental health claims now become the most frequent, most costly kind of claims within their health pool. And when it comes to mental health, we have a lot of the same questions as I mentioned in PTSD claims under workers' comp, right? What's the longevity of those mental health claims? How long will there be treatment? What are the long-term costs of them? What are the comorbidities, if you will? And how do all of those things come to bear on the ultimate loss costs of a mental health claim? COVID has presented a lot of question marks when it comes to health pools and the health claims that they face. Now, COVID itself wasn't exactly what we expected. In many benefit pools, COVID claims themselves were not as frequent, were not as costly as they might originally have anticipated. The prevalence within those covered populations wasn't as great as we feared. Some of the claims were covered by work comp presumptions instead. And thankfully, a lot of those COVID cases just weren't as severe as they could have been, which is not to diminish the number that certainly were. But overall, COVID wasn't quite the magnitude of event that health pools were anticipating. Similarly, there wasn't the resounding snapback of other services in a post-COVID environment. So during COVID, we were really worried that people were going to forego care, that they weren't going to get the preventive treatment that they needed, or they weren't going to get the maintenance treatment that they needed. And as a result, they were going to have this magnitude of very costly claims after COVID or in a post-COVID environment. Those snapback claims certainly did happen, but not to the magnitude that we expected in terms of the cost of those claims. Now, more recently, and I will say just in the last maybe 4 to 6 months, we have heard from a couple of pools who, and really just a couple, I will say fewer than 5, who are experiencing some odd blips within their claims, meaning that they've had a month or two within the last 6 of some really high claims experience, and what seems like some really sort of disconnected or one-off kinds of claim events. And the question that those pools are asking is, what is it that they're seeing? Are they just seeing a couple of blips every now and again because that happens in health pools? Are they seeing some impact that is a lag in the post-COVID impact that they were otherwise expecting? So is this that snapback of foregoing treatment that maybe pools expected a year ago? And so asking that question whenever a health pool, whenever you're seeing that sort of blip, you're constantly on alert. Is it just a blip? Is it the start of a trend? Is there something I'm missing? What other questions should I be asking? And again, just a couple of pools in the most recent 4 to 6 months seeing some odd changes in their claims behavior that has them paying close attention to that. Now, from a stop loss perspective and the purchase of stop loss, there's no normal among pools. And we have this conversation very frequently with our health pools, trying to compare their stop loss experience. It's really, really difficult to do. Stop loss renewals in 2023 were all over the board, everywhere from 8% to 45%. And that's sort of what we expect in the coming year too. We've heard about some increasing attachment points that might have an influence for some of you, but we know too that there are market options available. That said, in any given market, any given stop loss carrier may or may not be interested. So we have heard from pools who say, yeah, the market is robust. I've got lots of interest. I have options that I can pursue. And we've got a couple other pools who are saying, there really are not great stop loss options for my pool. And in fact, I'm pushing to get quotes. And I really only have my incumbent stop loss carrier as an option. So the market for stop loss is pretty varied. That's a pretty pool specific sort of experience right now. The final thing I'll mention for health pools, I mentioned that a couple of pools are seeing this odd blip or this odd spike in claims, and that's kind of capturing their attention. Part of the reason for that is that COVID really did put pressure on health pools' net position or member equity. And so it's always a consideration, but looking at some of those post-COVID claims patterns, looking at new costs like gene therapies, it's natural for pools to be taking another look at their equity models in a health pool environment. Now, there's a lot of methods for determining what the right amount of net position or member equity would be. These are very, again, pool specific sorts of considerations. What state are you in? What kind of plan design are you offering? What regulation do you have? What's your size of membership, your subscribers, the breadth of the plans and the services that you offer? So we hear all sorts of different net position target strategies. Maybe you're using risk-based capital. Maybe you're looking at a percent of contribution. Maybe you're doing some stochastic modeling. We have a number of pools with work currently underway to evaluate their net position or member equity in this environment. Now, I'm going to switch gears just a little bit now to talk about operational influences in pooling. So I talked a lot about those loss trends: property, liability, workers' compensation, health benefits. What kind of losses are pools experiencing? What kind of market pressure from a reinsurer or excess carrier perspective are pools managing through right now? There's another set of considerations that is just the operational reality for pools. So right now, what does that operational reality look like? Number one, it's carrying over that same net position strategy and review that I talked about in health programs. That's actually a consideration for all lines. It's not just a question of how much does the pool need in terms of its net position target, which is an important consideration, but it's also this philosophical consideration about the right balance of holding net position between the pool and its members. Who can hold capital most effectively? Who can utilize capital most effectively on behalf of the public entities that are served, the pool or the individual member entities? This is a question of the highest and best use of capital. Should we be increasing the pool's retained risk, taking more of that risk on ourselves? Should we be absorbing the increases in reinsurance premium within the pool without having to increase rates because we think maybe it's going to be a short-term need? Should we be forming a captive to address some of the changing needs in a novel way? And sort of look at different ways that we can segregate those risks from the totality of the rest of the pool's risks? Should we be experimenting with new coverage because cyber isn't an option on the market, and so, or in the market, the private market, so maybe we ought to look at some sort of direct coverage that we provide to our members? It's really an important time for all of these kinds of questions for pools. We have a challenging market environment, a hard market. So we have increasing reinsurance and excess rates. We have underwriting exclusions. We have novel coverages. Those things mean that pools have made higher use of their net position. They've used more of their net position in the most recent year or two than perhaps they have for the last 10 or 15 years. So you're seeing maybe some takedowns in your member equity for reasons other than giving a dividend, right? So maybe you've actually made use of that rate stabilization fund that you set up 5 or 6 years ago, and this is the first time that you've dipped into it. And so that's changing how you are thinking about your net position, your member equity, or your surplus, whatever you call it. And of course, maybe you have newer staff members, newer governing body members who need to know and appreciate the totality of all of those influences that might have you looking at net position in a different way in this environment. I'm going to talk more about that in just a minute. So really taking a look at your capital adequacy, your capital efficiency, how you're using that net position that your pool holds. Another big consideration right now for pools is technology, and we can't underscore this one enough. It's not just that, you know, there's new claim systems that we're having to adapt to. That's just the norm. I mean, that's just the noise and the normal course and scope of doing business at this point. What I mean by the technology influence is just the number of changes and how influential those changes are to pool operations. In some case, it might be a matter of bringing some degree of efficiency to your operations. Technology is most certainly shaping the member expectations that your members have, your public entities have of the pool and how they interact with the pool. There is a question of the shelf life of systems, and it's not just a claim system. It's your claim system, it's your policy system, it's your ERM system, it's your CRM system. Like, it's all of your systems having a shorter and shorter and shorter shelf life, which means that you are in this constant state of change when it comes to technology and systems. And then too, we have the security risks and how influential that can be and how much time and attention that takes from a pool perspective as well. I'm talking about the pool's own security risks, not the ones that you might be underwriting for your members. So it's the number of changes, it's how influential they are to pool operations, it's the magnitude of change management and projects going on. And all of a sudden, you've got pool executives who are spending the majority of their time talking about tech implementations and system implementations and changes and member portals and all of these things that are tech related. Plus, you have the novelty of the knowledge that it takes in order to manage this. So you do have to be conversant. Everybody at a pool has to be at least baseline conversant in some core technology terminology. And then you've got things like artificial intelligence and what that looks like in terms of the services that you are providing to your members, the systems that you are running. So that novelty of knowledge makes all of this tech stuff a big influence and a big challenge operationally for pools overall. And then no pooling influence presentation would be complete without a discussion about turnover in your staffing team. Let me just pause and give you the latest statistics. We have over 50 of our 200 pool executives who are new within the last 3 years. I think the count was 53 pool execs who are new within the last 3 years. And that's not the only pool staff, of course, right? That's just one good measure of how big the turnover has been within pooling. We know that staff positions in underwriting, in claims, and in finance are hard to fill. Pool positions in technology, also hard to fill. Those same turnover, the same influences that we're all facing with our pool staff, they are also too impacting our experts and the expert resources that we contract with and rely upon. So we're hearing from pools who don't get responses to their auditor RFPs. They can't find an alternative auditor to hire, or who are struggling to find actuarial firms with the time and ability to respond to an RFP request, or investment managers. So it's not just the pool itself, but all of those experts that the pool relies upon also have shortfalls when it comes to staffing and challenges when it comes to staffing. And then, of course, we have unprecedented turnover among our member contacts, requiring that all of our outreach be speaking to people who maybe aren't familiar with the pool, building familiarity, all of those prior comments about, you know, the staffing teams changing and everything else that's happening within your member organizations as well. And that turnover that's happening within your member organizations is also influencing your pool's governing body. So many pools have record number of new board members or new members on the governing body, which means As you're dealing through this hard market, which is maybe the first time your pool has dealt with it in the last 10, 15 years, as you're dealing with all these challenges and gene therapies and new kinds of ideas coming forward, new technologies, you are also teaching governing body members about how to think about these issues, right? And how to think about that reinsurance partnership and how to just onboard them into this pooling world and what the actuarial evaluation even is and what they need to know about it. That's pretty busy time for any pool who's going through this magnitude of operational changes. And there are a lot of operational changes going on. And by the way, you're managing all of those changes, right? All of these operational changes, all of those lines of coverage and loss changes, you're managing all of them in an altogether new hybrid work environment with new expectations, with a new pool culture, with what your employees want from you and how they want to interact in this new environment as well. So it's a whole new world out there, and we're all managing as we go, of course. Amid changes like this, we know that pool-to-pool collaboration is key. Maybe you've heard the saying, knowledge is power. But in pooling, we know better. We know that sharing knowledge is power. And that's what we mean when we say that AGRIP's purpose is to energize the power of pooling, making member organizations more effective, more collaborative, and informed. We know that when we all share information and share pooling knowledge, the whole of pooling becomes more effective, more collaborative, and certainly more informed. So at AGRIP, our role always is to bring all of those bright ideas, great minds together to help make pooling successful, because sharing your pool's knowledge and gathering insights from other AGRIP member pools is what will help you navigate all of these trends, all of these influences, and more. I said it at the beginning, for any issue that you are facing, I can almost guarantee that we will find 3, 4, 6, 12 other pools who either are experiencing the same thing or have experienced the same thing. And every single one of them is willing to share their information with you. So make sure that you're reaching out to us. You're letting us know what those influences are that you need help with, and we'll make sure to put you in contact with some others. Thank you for attending today. We'll see you soon.